Okay, welcome back to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we're going to be talking about maximizing your profits by trading debit and credit vertical spreads. These two vertical spreads are very versatile and really allow you to take directional exposure in pretty much all different market conditions and be able to profit from everything from mild directional views to strong directional views. So today what we're going to do is we're going to analyze what the difference between these two strategies are. I'm going to break them down so that you understand the fundamental difference between the two. I typically get a lot of questions from users asking how to compare the two. And in reality, you shouldn't be comparing the two because the two strategies are actually quite different. The nature of each strategy is completely different from each other, where I actually think it's not even fair to try to compare debit versus credit spreads. So what we really want to analyze is understanding when should you use each one, how should you structure them so that you're deploying your capital as efficiently as possible, so that when you're taking a directional view, you're allocating your capital the correct way for the directional view that you have. So those are the things that I want to go over with you today. I want to make sure that at the end of the webinar, everyone is clear as the difference between debit versus credit spreads, and most importantly, understand when is the correct market environment to deploy each one of these two strategies. So before I get started, just a bit of housekeeping. For those of you that are brand new to Options Play, welcome. You can sign up for a free 30-day trial for the platform that I'll be showing later at optionsplay.com. When you become a member, you'll get free access to webinars like we have weekly webinars like this every single week. I will, during the webinar, talk about previously recorded webinars, especially if you want to learn more about debit spreads and credit spreads. I highly recommend you take a look at some of the links that we'll be sending out with the slides after the recording. Important links such as to our options education webinars. So if you want to look at some of the previously recorded webinars, make sure you click on these important links. For those of you that are interested in some of the trade ideas that we have, I'll talk at the end about the two different services that we offer for debit spreads and credit spreads, so that you can see different trading ideas from Options Play for both of these strategies. And lastly, if any of the terminology that I talk about is unfamiliar to you, or you want to learn more about options in general, I highly recommend you to take a look at the Options Industry Council. So this will all be included with the recording and the slides that I send to everyone after the webinar is done here today. So with that, let's go ahead and get started. I want to talk about a few different things, and I'm going to break it down really simple. First, I'm going to talk about what are vertical spreads so that everyone understands what is a debit spread and what is a credit spread for those of you that are brand new. Then I'll talk about when you should use vertical spreads, because they are useful for a large variety of different outlooks on any stock or ETF. So I want to make sure that you understand the difference between the two strategies and understand when you should be using them. And lastly, what we'll cover is how to trade these spreads effectively. So what are the best practices, everything from how to get into the trade, what expiration and strike prices to choose, as well as managing the trade. And lastly, what we'll do is we'll go over to Options Play, and I will show you some examples of stocks with different outlooks on those stocks and why you should deploy debit spreads on some of them versus credit spreads on others. So we'll go through some live trading examples to show you what we're going to be teaching here today. So before I get started, I just want to do a quick poll here for those of you that are here. I just want to get an understanding of how many of you have traded debit versus credit spreads, which ones have you traded, and how many of you are here just simply to learn because you've never traded one of these strategies here before. So please just answer the poll on your screen. So this looks like a pretty even split, but looks like debit spreads are the predominant favorite here. About a third of you trade debit spreads, about a fifth of you trade credit spreads. A smaller percentage of you trade iron condors, which are effectively a combination of credit spreads, and about a quarter of you are here to learn more. So that's great. That's a pretty diverse audience here. Hopefully this will have something for everyone. This is really designed to help you guys number one, understand these strategies from a fundamental perspective, because I tend to see a lot of traders trade debit versus credit spreads based off of things that they've learned elsewhere, but they don't really understand why they're trading a debit spread versus a credit spread. So those are some of the things I want to dive into. And then for those of you that have never traded a debit or credit spread before, this is really designed to help you guys learn more about these strategies so that when you do trade them, you understand how to deploy them correctly. So let's go ahead and get started here. I'll leave this poll up here for 1 second. We will leave question and answers to the end. For those of you that have questions, I will spend about 15 minutes on the slides. I will try to spend as much time as possible on options play, showing you examples of real stocks with real outlooks and showing you the difference between trading a debit versus credit spread. So we're going to start off by talking about what is a vertical spread. So there are 4 types of vertical spreads that you can trade. You can think of them as 4 different quadrants. You can trade bullish vertical spreads, or you can trade bearish vertical spreads. And within each category, there are 2. There's a debit spread and a credit spread. That's what we're here to understand. What is the difference between all of these, even though many of them may look or feel similar? So on the bullish debit side, you have a long call vertical. This is probably one of the first spreads that many of you that are newer to options will probably trade, either a long call vertical or a long put vertical. These are relatively simple to understand if you understand buying a call or a put. You're effectively buying a call or a put and selling an additional leg against that to offset the cost of that call or put, to reduce your risk, to reduce your overall capital outlay. On the credit side, when you're bullish, you would trade a short put vertical, and on the bearish side, you trade a short call vertical. This is a little bit more complicated, but we will walk you through each one of these strategies so you understand the difference. So we'll start off by talking about what are vertical spreads. Whether you're trading a debit or credit spread, why should you consider looking at vertical spreads? And the predominant reason that I really prefer trading spreads versus all other forms of options is really the fact that vertical spreads give you predefined risk and reward, which means that before you get into a trade, you know exactly what your best case scenario is, what's your max profit, and you also know what your max loss is or max risk. That means that you can plan out your trade ahead of time. You know what the worst and best outcome is going to be that you wouldn't be able to get if you're trading some other strategies. If you're buying a call, you have unlimited reward, or if you're selling a call, you have unlimited risk. It's difficult to plan for that when you're trading. So with vertical spreads, you know exactly what you're getting yourself into, makes it a little easier to manage from an emotional perspective. And once you're in the trade, you know what the possible outcomes are. So for this, to show you, to help you better understand debit versus credit spreads, I'm going to use a fictitious stock XYZ trading at $100. And I'm going to go through a couple of examples to show you how to structure these trades so that you understand what the difference between debit versus credit spread is. And then we're going to go into some more details in the next few slides to help you better understand these strategies. So on the debit spread side, like I said, the debit spreads, you can think of them as very similar to buying a call or a put, because what you're really doing, the crux of the trade really is still that long call or long put. What we're doing is we're just adding something to that to effectively lower our risk. So if you think about a long call vertical, it's very similar to buying a call option, because that's what you're starting off with. You're buying a 100 strike call, and you would do that because you're bullish on the stock. Because if you were bullish on stock XYZ, a simple option strategy you would deploy is simply buying a call option. That's exactly what we're doing here. We're buying a 100 strike call. That is a bullish strategy. But because buying a 100 strike call has unlimited reward, it also potentially has quite a bit of risk, because outright buying a call sometimes is quite expensive. In order to offset that, what we're doing is we're selling an out-of-the-money call, a further out-of-the-money call. And what that does is it brings in some premium, and that offsets the cost of buying a 100 strike call. And that offset will help reduce your risk. It will reduce the break-even price that the stock needs to move to in order for it to be profitable. It also does some other things, such as reducing the time decay of the long leg. So there's a lot of added benefits that you get from trading a call vertical versus buying just outright buying a call. So for those of you that are buying just calls and puts right now, you can think of it as almost like graduating to the next class. You started off with a simple option strategy. Now we're moving on to a more advanced strategy that will give you some additional benefits. And that's the best way to think about debit spreads. On the put side, it's just simply the opposite. Just instead of trading a call option because you're bullish, you're now trading a put option because you're bearish on stock XYZ. You have an outlook that stock XYZ will move from $100 maybe down to $95 or $90. So traditionally what you would do is you buy a 100 strike put. That's a put option that will allow you to profit if stock XYZ moves lower. However, buying that put also sometimes can be quite expensive, and you have unlimited reward to the downside, but that's only if the stock goes to zero, and chances are you don't think the stock's going to go to zero. So one of the ways to offset your risk and offset your cost is to sell an out-of-the-money put. Selling that $90 put does the exact same thing as the selling that out-of-the-money call. It reduces the cost of buying that $100 put, reduces your risk, and reduces the break-even price where the stock doesn't need to move as far for your strategy to be profitable. So those are some of the benefits that we're going to explore here today for those of you that are newer to debit spreads. On the flip side, for credit spreads, this is quite different. Credit spreads by nature is a completely different beast. Even though they are still bullish and bearish strategies, they are quite different in nature, and I'll show you why. So again, when stock XYZ is trading at $100, if I'm bullish on the stock, here's where it gets quite different, because you start off by selling a 100 strike call. That in itself is a bearish strategy. So selling a short call vertical is actually a bearish strategy. And the reason that we're trading a spread here instead of outright selling the call is because if you just sold a naked call, you have unlimited risk. That's not a position you want to be in, regardless of what option strategy you trade. So by selling that 100 strike call, I'm now bearish on stock XYZ. And as long as the stock stays at 100 or goes lower, I'm going to be profitable. But if the stock really moves higher, I have unlimited risk to the upside. So that's why you want to buy a 100 strike, a higher call, an out of the money call to help offset your risk. So that allows you to take that small, modestly bearish view on XYZ, but make sure that in the case that you're wrong on that trade, you have limited risk and not unlimited risk. And that's really the key or the nature of selling credit spreads. So on the flip side, if let's say you're bullish on stock XYZ or mildly bullish on stock XYZ, you could sell a put, an out the money put. That in itself is a bullish strategy, and as long as stocks XYZ stays at $100 or moves higher, you're going to be able to profit by selling that 100 strike put. But just like selling the naked call, you have unlimited risk. So one of the ways to mitigate that risk is by buying a lower put, an out of the money put. So here we're buying, let's say, a $90 put, and that helps offset your risk so that no matter what happens, you have defined or limited risk to the downside. So that's the nature of trading credit spreads. And the difference really is when you buy a call, the stock needs to move a certain amount in order for the strategy to be profitable. When you sell a 100 strike call, as soon as the stock is at 100 or lower, you will be profitable. So that's the difference between buying a call option, because then the stock needs to move a certain amount for you for the stock to be profitable. When you sell a credit spread or when you sell a call or a put, the stock actually doesn't need to move very much. Even if it stays where it is, you're still going to be profitable. And that is the fundamental difference between trading a debit versus credit spread. And that's what we're going to explore here today. So the goal of trading a debit spread is to offset the cost of that long call or put, usually by about 10 to 20%. So if you're used to buying calls and puts, imagine being able to buy them at a discount of about 10 to 20%. That's really what you're going to be able to get by trading debit spreads. And as far as picking expiration and strike prices for your debit spreads, because when you buy a debit spread, just like when you buy a call or a put, you're short theta, meaning theta is working against you, time decay is working against you. You want to try to minimize that as much as possible. And the only way to do that is by purchasing options that are at least 1 month from expiration. We usually like to go about at least a month and a half, maybe even 2 months out as a starting point when we're buying any calls or puts, and that works the same way for when you're trading debit spreads. As far as strike prices go, the first leg works the same way as buying a call or a put. You want to buy an at the money or an option that's very close to the current price. So roughly about a 50 to 60 delta is usually a good starting point for the long leg of a debit spread. And then when you sell an out of the money call or put option against that long leg, you want to make sure you sell an option that's relatively far away from the current price. So we usually look at roughly about a 1 standard deviation move away from the current price, which means that you're selling roughly about a 15 delta call or a put against that long call. And again, that's going to bring in roughly about 10 to 20% of the long call's premium by selling that far out of the money call or put. And that offsets your risk, it reduces your risk by about 10 to 20%. It means that the stock does not need to move as far in order for your strategy to be profitable. And because you have a short leg, you are also maximizing or rather minimizing your theta decay. You're minimizing the rate at which your option is decaying with time. So those are some of the benefits of trading debit spreads versus outright buying a call or a put. For credit spreads, it's flipped on the other end. So when you're selling credit spreads, you're long theta. So theta is going in your favor. So in this particular case, in order to maximize that time decay, what you want to do is you want to actually sell relatively short dated options because time decay accelerates as you get near expiration. So when you sell credit spreads that are just a few weeks from expiration, theta is decaying very fast, and that's profit for you. So that's really why you want to sell relatively short dated options. When it comes to selling credit spreads, there's a lot of choice that you have with respect to strike prices. However, we tend to find that there's a golden ratio when it comes to selling credit spreads. And that's where the credit that you receive on a credit spread should roughly be at about a third of the width of the vertical. And when I say the width of the vertical, that's the distance between the two strikes. So in the example that I gave before in stock XYZ, where I sold a 100 strike put and bought a 90 strike put, the width of that is $10. So the golden ratio that you want to aim for is where your credit is roughly about a third of the distance of that width. So if I'm selling a $10 wide credit spread, I want to collect roughly about $3.33. That's how you could go about finding your strike prices. Another way to think about that is roughly selling an at-the-money option, so roughly a 50 delta call or a put, and then buying back a 25 delta call or a put against that. That will usually get you very close to that golden ratio of collecting a third of the distance of the vertical. So those are some best practices for why you should trade debits versus credit spreads and how you should structure these trades. So next, what I want to look at is understanding a little bit about what it feels like to trade these two strategies, because I actually surprisingly get a lot of questions where a user will say, I'm bullish on Apple. Should I trade debit or should I trade credit spreads? Or I'm looking at the two. How do I decide which one should I trade? And the answer is they're actually completely different in nature, where I don't actually think it's fair to compare a debit versus credit spread. And the reason for this is because in order to understand the difference between debit versus credit spreads from a trading perspective is you really have to understand the relationship between probability and risk to reward. Whenever you're doing any form of trading, whether you're trading options, stocks, futures, FX, what you're doing is you're making a choice between risk to reward and probability. And debit spreads fall on one end of the spectrum versus credit spreads are on the opposite end of the spectrum. When you're trading debit spreads, you generally have low probability of profits or low win rates. So whenever you're trading debit spreads, you should expect that probably only about 30 to 40% of your trades are actually profitable. And a lot of people will say, that doesn't sound very good. I don't want something that actually loses more times than wins. However, the flip side to that, and that's really where you have to look at both sides of the picture before you decide anything, is that when you trade debit spreads, you typically have very good risk-to-reward ratio. This is personally why this is one of my favorite strategies, is because I can risk $50 to try to make $100 on a trade. So when I'm right, I actually don't have to, I only have to be right about a third of the time in order for me to be profitable. And as long as I'm right more than a third of the time, I can make money using this type of strategy. So don't discount a strategy just because it has low win rates or low probability of profits. Make sure you look at both sides of the equation. Look at how much the risk reward is, because the risk reward will typically help offset the low probability of profit that you see on a debit spread. Conversely, on credit spreads, you actually see very high probability of profits. Many times, a lot of credit spread traders will target 70, 80. I even see credit spread traders targeting 90, 95%. And I tend to think that traders target these type of strategies because it sounds really good to win all the time. However, there's a really bad trade-off on the other end of this when you do win all the time, is that when you lose a lot of money. So you can certainly find credit spreads that have 95% probability of profit. However, that 5% of the time that you lose, many times you're losing 10, 20, 30 times what you collected on the first 20 trades that you won on. And a lot of times you end up wiping 20, 30 trades off the table by one single loss. And that's really the downside, in my opinion, to trading credit spreads, especially very high probability credit spreads. So that's really why when I talk about the golden ratio of credit spreads, targeting about a third of the width, is because when you target those types of ratios, the probability of profit actually isn't very high. It's actually only about 60, 65%. And with that, your risk reward is not as bad as some of the high probability credit spreads. So when you're trading credit spreads, it's not uncommon to see 70, 80% winners on credit spreads, but the trade-off there is that you're typically risking substantially more money than what you're collecting on the credit. Many times you might be collecting $50 on a credit, but risking $150 if you're wrong on that trade. So if the trade goes against you, not only do you lose what you gained in credit, but you lose 2 times that. And that's really the trade-off. And at the end of the day, one is not better than the other. It's really just important to understand that they are at 2 different ends of the spectrum, and you need to make sure that you're comfortable at the whichever end of the spectrum that you're on. And many times you might find yourself on both ends of the spectrum. I certainly trade both debit and credit spreads, and you just have to understand they are completely different beasts as far as trading. So on the next slide, I want to give, for those of you that have never traded a debit or a credit spread, a little bit of a taste as to what it feels like to trade a debit spread, because I think almost a quarter of you said, almost 80% of you have said that you've never traded a credit spread, and about 2/3 of you have never traded a debit spread. So I think it's really important to understand what it actually feels like from a trading perspective to trade these 2 strategies. So, like I said before, with respect to debit spreads, these are low probability but high risk reward, which means that you typically have fewer winners, but you do have larger rewards on the trades that you do win. So many times a win rate for a debit spread is 40, 50%, which doesn't sound very attractive. However, most debit spreads will have a max risk of maybe $50 and a max reward of potentially double that, which means that if I'm looking at 5 trades, I might actually lose 3 out of those 5 trades. However, on the 2 trades that I win, instead of losing, I'll lose $50 on the 3 trades that I lose, but I'll gain $100 on the 2 trades that I win, which yields me a net profit of $50 at the end of 5 trades. Conversely, on the other end of the spectrum, when you're trading credit spreads, you're going to see a lot more winners with much smaller rewards. So you're going to be collecting a lot more winners, but when you lose, you're going to lose relatively large. So with credit spreads, I might win 80% of the time. So out of 5 trades, I'm actually winning 4 of those trades. But the 1 trade that I lose, I'm going to lose roughly $150 versus only collecting $50 on the other 4 trades. So the net result at the end of the day is actually similar. So as you can see, just having a high win rate or having a high risk reward isn't necessarily better. You have to look at both in conjunction with each other to see how good is your strategy. So this is really what I want to illustrate for users, is that even though they are completely different strategies, you can think of them as quite similar at the end. However, it's a completely different path to how to get there. And that's really what I hope this webinar helps you understand as you go through learning these strategies. So Next, what I really want to cover is when you should utilize vertical spreads. We've now looked at what vertical spreads are, how to construct them, the difference between debit versus credit spreads. In order to understand when to deploy them, I want to go through some real examples because that's really what's going to help solidify when you should utilize each one of these two strategies. However, with respect to debit spreads, you really need to use them when you expect a large or quick move in one direction or another. This is the only time you should be using debit spreads, only when you expect a large and quick move. So traditionally, what you would be looking for those of you that use charts is perhaps breakouts, breakdowns, or perhaps a rebound off of a support or resistance level. This is really where you're going to be able to get that quick and fast move that's going to be able to allow you to take advantage of a debit spread. And generally speaking, debit spreads will be more profitable in a lower volatility environment. And this is one of the things that I do want to address, is that while debit spreads is more profitable in a lower and volatility environment, just when you are in a higher volatility environment, that doesn't mean that you can't trade debit spreads. And I'll talk a little bit about on the next slide as to why that's the case. On credit spreads, it's the exact opposite. You only want to utilize credit spreads when you expect a neutral or modest move. And I think once I show you some examples of stocks with some different outlooks and put the two side by side, it's going to become really obvious as to why you should trade debit spreads when you expect a quick and large move, and why you should trade credit spreads when you have more of a neutral or modest move. So for those of you that are technical analysts, you want to utilize credit spreads when you've identified some kind of oversold or overbought condition. So for those of you that use technical indicators like MACDs, stochastics, or RSI, these are all momentum indicators that give you a sense for overbought or oversold. You can also use tops and bottoms, double tops, double bottoms, reversal patterns. These are all ways to identify points of reversal, and those are the ideal times to enter a credit spread. And yes, credit spreads are more ideal or will give you better results in a higher volatility environment, but I do want to point out that when you are in a lower volatility environment, that does not mean that you can't trade credit spreads. So keep that in mind as we move on to the next slide, because what I really want to talk about is the difference between debit versus credit spreads when it comes to volatility environments. And then what I want to do is show you guys some charts to give you a better visual understanding as to when it's best to trade debit versus credit spreads. So again, it's ideal for you to sell credit spreads in a high volatility environment and trade debit spreads in a low volatility environment. But many of you may have gone through other forms of education or seen stuff online that tells you when it's high volatility, sell credit spreads. When it's low volatility, buy debit spreads. However, that, in my opinion, is an oversimplification of volatility, and that doesn't address a big problem with that statement. And it's the fact that regardless of whether you're trading debit or credit spreads, you have much larger delta exposure, meaning you have a lot more exposure to the underlying price movement than you do to the change in volatility. Credit spreads do take advantage of a high volatility environment that's lowering, and debit spreads does take advantage of a low volatility environment that's rising. However, the exposure that you actually have, meaning the profit that you can get from that change in volatility, is actually really small compared to the change that you'll have in the debit or credit spread when the stock moves higher or lower. And that's the one thing that I think is oversimplified with the statement of selling credit spreads when it's high, buying debit spreads when it's low. So that's one of the things I also want to show you using our P&L simulator, is that you should be choosing your strategy not based on volatility, but based on the directional exposure or the directional outlook you have on your stock. Because if you choose a strategy based on volatility alone, you will see that you're going to get suboptimal risk to reward on your trades. And I have some examples to show you that to you to make this a little bit more apparent. So on a chart, I do want to show you visually when you want to take or consider using a debit spread. So on a breakout is really where you want to consider using a debit spread, because on a breakout, you're really expecting a quick, fast move in one direction or another. So here I have an example of a stock that traded between a pretty wide range between 94 and 103 until it kind of continue to you would say, formed the triangle and made smaller and smaller movements until it broke out of that triangle, and it had a very quick and fast move breakout from about 99 all the way up to about 105. So when you see a stock break out, whether it's break out of a trend line or break out of a support and resistance level or some kind of formation like a triangle, those are opportune times to consider taking a look at debit spreads, because you typically get a quick, fast move in one direction that you can identify very quickly and be able to use a debit spread to extract as much profit as possible with the least amount of risk. Conversely, when you're selling credit spreads, here on the right-hand side, when the stock starts to move in a sideways pattern in a very tight range, and especially when you see on an oscillator, when the stock oscillates between overbought and oversold very quickly, that's an ideal time to sell credit spreads. So every time the market moves towards a floor, that's when you want to sell put credit spreads. And when it reaches that ceiling or oversold or overbought, you want to sell call credit spreads. And one thing that you'll notice is that on this whole chart, I only see one opportunity to trade a debit spread versus I probably see at least 6, if not 7 opportunities to sell credit spreads. So that is another distinct difference between debit versus credit spread trades, is that when you're trading debit spreads, you're likely going to be trading debit spreads once in a while on a lot of different symbols, versus if you're selling credit spreads, you might find yourself trading credit spreads on the same symbol over and over again for a short period of time. And that is fundamentally why these two strategies are different, and they're really not comparable to each other. So when you think about trading any of these strategies, first think about, what's my outlook on the stock? Do I think it's going to make a big move? If I do think so, take a look at debit spreads. If I think it's simply going to reverse and move and have more of a neutral view, that's when you're better off selling a credit spread. So how do we manage these? When you're trading debit spreads, you want to time your entries with an expected large move. So any type of breakout, that would be an ideal time to enter a debit spread. As far as managing a debit spread, this is really part of the reason why I really like trading debit spreads, is because managing them is really easy. There's pretty much one set of rules that you can manage all debit spreads with, and it's really easy to remember. So the first thing to remember with trading debit spreads is that you want to cut your losses if the expected move that you're expecting does not materialize. So if you see a stock is breaking to new 52-week highs, and you think it's going to continue moving higher, and after a week it just continues to move sideways, and that move that you're expecting just doesn't materialize, cut your losses, get out. And when you're trading any debit spread, your goal is to always exit before expiration, either at a gain or a loss, but you always want to exit before expiration. You never want to hold debit spreads all the way till expiration. The only exception to this is if the stock really moves really against you very, very quickly, where you don't even have an opportunity to get out and the spread is basically worthless, you probably will want to just hang on to that debit spread and hope that you get a big move back to at least cut some losses. But a lot of times, if you buy a debit spread and it moves very quickly down to a few cents or pretty much worthless, that is the only time where I think it makes sense to hold that trade to expiration. But as far as exiting a trade prior to expiration, this is where the rules of debit spreads are really easy to remember, because you want to cut your losses if you've lost 50% of the debit spread or what you've paid for. So if you paid $1 for that debit spread and it's now trading at 50 cents, time to cut your losses and move on. On the upside, if you've gained anywhere from 75 to 100% gain on a debit spread, that's when it's time to, at the very least, take partial profits. You want to, if you're trading multiple contracts, you can at least take a few contracts off, take some profits, and keep a few more contracts on. But if you're only trading 1 or 2 contracts, you usually want to take profits within once you reach that 75 to 100% gain on a debit spread. On credit spreads, as far as entry goes, you want to time them with market tops and market bottoms, or you can also use overbought or oversold conditions. That's another way to identify when it's time to get into a credit spread. And remember, you can string calls and put verticals together, meaning you can actually sell a call credit spread right after you sell a put credit spread or a few days after you sell a put credit spread, even if the puts haven't expired yet. That's really one of the beauties of selling credit spreads, is that you can do it over and over again, sometimes on the same stock, where you might actually do it on the same expiration. And that's really where you can actually form iron condors for those of you that do trade that strategy. I don't recommend selling an iron condor as a strategy as a whole, but if you leg yourself in where the markets are oversold, so you sell some puts, and then when the markets are overbought, you sell some calls, and those two combined become an iron condor, that's really, in my opinion, the only time you should be trading iron condors. And with respect to managing credit spreads, the goal of a credit spread really is to hold that credit spread to expiration and let it expire worthless. So this is like selling a covered call or a cash secured put, where the goal is to simply let that call or put or that spread expire worthless. With respect to taking profit on credit spreads, this is really where the rule is a little fuzzy, but the best way to describe when to take profit on a credit spread is take profits when you're ahead of the game. And what that means is that when you've made more than 50% of the profits that you can collect on a credit spread, but you still have plenty of time to go. So if you have more than 2 weeks left, so if you sell a four-week credit spread, and when you still have more than 2 weeks left to go, you've already gained more than 50%, that's when it's time to take profit. Whenever you're ahead of the curve, take profits. And this is where we don't feel that it's the right thing to do, where to hold it all the way to expiration just to try to collect another 20 or 30%. It's not worth it. Take your profits, move on. You can deploy your capital again with a new credit spread. With respect to cutting losses, this is really where it gets, where it depends. It depends on how much premium you're actually collecting off of the vertical width. So again, the vertical width is the distance between the two strikes. So if you're collecting more than 20%, so if you're using the golden ratio that we're talking about and you're collecting a third of the width, then you want to cut your losses when you've lost anywhere from 75 to 100% of the vertical width. Versus on the premium, if you've collected less than 20% of the vertical, if you've collected less than 20% of the vertical width, that's when you want to cut losses of anywhere from 100 to 200% of the credit that you receive. So you need to give yourself more room on if you're collecting less than 20% of the vertical width. So those are some of the best practices for managing both debit versus credit spreads. So what I really want to do now is go through some live examples comparing debit versus credit spreads and showing you the difference between the two with some live examples. So first off, what I want to look at is IBM. Now, I'm just picking out some big stocks that most of you are familiar with, and I picked up IBM because it's a stock that has seen quite a rally since the December lows. So it rallied from about 108 all the way up to 138. So roughly about a 30% move in about a month and a half. So that's quite a move. And I think for most users, this might feel a little overextended. I would expect at the very least that there's some kind of pullback or consolidation, just because stocks don't move straight up. They tend to move in waves. And we've gotten one very, very strong wave up in IBM. So there's really two ways to look at this. I either think that this is at least going to pause and not move much higher in the short run, or for those of you that are a little bit more aggressive, you might think that there's a pullback at the very least to maybe about 132 or 130 or so on IBM. So that's the two alternatives I want to look at. I understand that this is a counter move, meaning this is trading against the trend. This stock is relatively strong. It's got a technical score of 7. The 1 month and 6 month trend is bullish. So this is a really short-term tactical play, and this is by no means a recommendation or advice to trade any of these strategies. But I just wanted to point out, if you believe that this stock was going to make a brief pause and maybe a small pullback, how you should look at this, when should you use debit spreads, when should you use credit spreads, and really show you the difference. So we'll start off by clicking on I'm bearish for IBM because we want to look at some bearish strategies. And what I want to do is I just want to put a credit spread next to a debit spread and show you the difference. So what we'll do is we'll modify buying a put. We'll modify that to selling a call credit spread. So again, for selling credit spreads, you want to sell a credit spread that maybe is about 30 days out of the from expiration. We always want to collect roughly about a third of the distance between the widths. So if I'm selling a 138, 143, that's a width of $5. I'm collecting $1.71, which is just about a third of the $5 width. So, or a little more than $5 width. So let's compare selling that credit spread versus outright buying that debit spread on IBM. IBM's at 137 right now. We're going to utilize our P&L simulator to help us understand these two strategies and see how they perform with different outlooks. So the first outlook I had was that simply this stock has rallied 30%. It's likely going to, at the very least, pause before it continues moving higher. And we've seen a lot of that over the last few weeks. It really hasn't moved much higher in the last 3 weeks or so. You know, it was at 134 just a few weeks ago, and it's pretty much been around 134 up until just a few days ago and pulled back a little bit today. So what happens if I think the stock's really just going to sit around here around 136, 137, and 137, and we'll put an expiration date on the March 22nd date, which is the first expiration date of these two strategies. So as you can see, if the stock stays around 136, 137, if I had bought a debit spread, and keep in mind, IBM right now, implied volatility is quite low. It's at 16%, very low for IBM. So you might be inclined to buy a debit spread because implied volatilities are low. But as you can see, if the stock stays exactly where it is, around 136, 137, if I bought the debit spread, I'm actually losing money. Versus if I sold the credit spread, I collect $171, the full credit that I receive, as long as IBM stays where it is or moves lower. And even if the stock moves higher, even if it goes up to 138, I can still collect my full credit by selling a call credit spread. If I bought the debit spread, I'd lose a third of my investment. So this is really where you want to make sure that you understand the difference between these two strategies and deploy them based on your outlook on the stock and not based on volatility, because no matter how low volatility is, and even if volatility expands from 16% and doubles, let's say it doubles to 24%, or grows by 50% rather, as you can see, you're still losing money, even if volatility expands when the stock doesn't move anywhere. And that's really why you want to optimize your strategies based on your directional outlook and not based on just your volatility outlook. So now let's look at, well, what happens if IBM does pull back? So maybe I think it might pull back to, let's say, 134, 133. So if it does that, and let me reset volatility here again. As you can see, if I sold the credit spread, I make $171. On the debit spread, I make $214. Now, maybe these two aren't fair comparisons right now because one is risking 329, one is risking 258. So one of the ways that we can make this a little bit more fair is, let's say we're risking the same amount of money. Let's say we're risking roughly $1,500. So here now I'm risking $1,300 versus $1,300. So these two are the same. Now let's compare them apples to apples. So if the stock moves down to 133, here I make $684. Here I make $1,072. So even if the stock moves modestly down to 133, that's when the debit spread clearly outperforms the credit spread. And this is really why your outlook is the most important piece to look at when you're when you're deciding between a debit versus credit spread. Because as you can see, even if the stock moves, even if it doesn't move as much, even if the stock just only needs to move to about 134 before these two strategies are comparable. So if you think the stock's going to move to 134 or more, that's when you want to trade the debit spread. If you don't think it's going to move down to 134 and you think it's going to be a little higher than that, that's when you want to sell the credit spread. And that's really where you want to put the two side by side, use our P&L simulator, and that's going to allow you to understand exactly when each strategy will be profitable. Now, let's say that I do think that modestly it'll pull back to maybe 130, which is, in my opinion, a fairly reasonable price for this to pull back to, or maybe let's say 131. Here, as you can see, on the credit spread, I really have limited limited reward. I can only collect the credit that I receive, no matter how far IBM goes. Even if it goes to zero, I'm still only going to make $684. Versus on the debit spread, even though I'm risking the same amount of money, $1,300, I can make up to $2,700. So if the stock moves down to 131, I actually make more than double what I made on the credit spread. And if the stock really plummets back down to 124, that's really where I'm able to make almost $2,700. So that would be a pretty extreme move, and I don't think that that's necessarily realistic. But I think at the very least, if you do get a pullback to about 131, that you will get a significantly higher profit on the debit spread versus the credit spread. Again, which is why I don't believe that you should optimize your strategies based on just high vol or low vol, because your directional view is far larger, has a far larger impact on your P&L than the changes in volatility. Because even if volatility increases from 16% all the way up to 24%, which is a huge change in vol, the difference in profit is from $1,600 to about $1,400. So difference about $150 or so, versus if I had used, even if this stock moves down just a few dollars more, as you can see, I'm making a few $100s more. So this is really where, again, your delta exposure or your exposure to the stock price is far, far larger than any exposure you have to volatility. And that's why, again, I highly recommend when you're choosing between debit versus credit spreads, you use your directional outlook first before you decide whether you want to trade debit versus credit spreads. Lastly, I want to do one more example before I open this up for Q&A. I was looking at Rockwell Automation. This is a industrial stock. They make seats for airplanes. However, as you can see, this stock has really hit a bit of a quadruple top here. It's really struggled to make it any higher, around 180 or so. And it's just it touched 180 just a little bit yesterday and started to bounce off a little. So there's two ways you can look at this. You can look at this as saying that I don't think the stock's going to move above 180. It's really struggled to move above 180. It just can't seem to do it. Or you can see this as a potential pullback, because every time it hits 180, it pulls back to roughly about 165 or so. That has happened 3 times since November. So November, it hit 180, bounced back to 165. In early December, bounced back all the way to 140 and went all the way back up to 180 just to get bounced back to about 165 again. So 2 ways to look at this. Again, I'm going to click on I'm bearish. Again, I'm going to set up a call credit spread. Here in this particular case, let's look at a March. There's not a lot of strikes here, so let's see. Can I sell a 185? 190, so that's roughly a $10 wide, that is a $10 wide credit spread. I'm collecting roughly about a third, so 345, which is actually exactly a third of the $10 width. So let's compare buying that debit spread versus that credit spread. So using our P&L simulator, if I simply think Rockwell Automation is just going to stay right where it is, around 180 or so, it's not going to move any higher. I think by April 18th, it's going to be at 180. Then, as you can see, if I bought the credit spread, or before I do that, let's first make sure that I'm risking the same amount of money. So let's say I'm willing to risk $2,500 on this trade. So here I'm risking $1,900. Here I'm risking $2,100, roughly the same amount of money. If the stock stays at 180, if I bought the credit spread, I make $1,000 profit. If I bought the debit spread, I lose $2,100. So very clear that if I think that Rockwell Automation is going to stay where it is, or even around 175, here I'm going to make a lot more money on selling the credit spread versus buying a debit spread. Here I'm going to lose $160 versus making $1,000. But if I do think the stock's going to pull back like it has the last 3 times, let's say modestly to 170. Here, I'm still only going to collect $1,000 on the credit spread, but I'm making $1,800 on the debit spread. So even on a modest pullback, the debit spread gives me substantially more, almost double the return as the credit spread with the same amount of risk. So I'm risking $2,000 roughly on both of these 2 strategies. But if I think the stock's going to move down to 170, I'm far better off trading that debit spread. Again, even if Rockwell Automation implied volatility is really low and you've been taught to buy debit spreads when volatility is really low, Debit spreads is very good if you do expect that large move, but if you don't expect that large move, as you can see, debit spreads will not be a good strategy. But when you do get that large move, so if that stock moves down to 165 like we were talking about originally, here on the credit spread, I'm limited to that $1,000 that I'm going to collect. And if I'm wrong, I'm going to be risking $2,000 versus on the same debit spread, I'm still risking $2,000. But if I'm right on this trade and it does pull back to 165, I'm making quadruple the money that I'm making on the credit spread. Again, this is why I advocate that when you're choosing between debit versus credit spreads, you use your directional outlook as your first guide before you to choose between the two, and not use volatility to choose which one of these two strategies to trade. So with that, what I hope to have explained to you guys today is really, number one, an understanding of these two strategies from a fundamental perspective to know what the difference between these two strategies are, and more importantly, show you some real examples so that you can feel confident in your abilities to put the two side by side and be able to make a decision as to which one's the right strategy for you based on your outlook for the given stock or ETF. So with that, I want to thank everyone for taking the time out this afternoon. What I'll do right now is I'll open this up for Q&A. So if you have any questions regarding anything I explained here today, please type them into the chat window. And while you guys submit your questions into the chat window and the Q&A window, I just want to tell everyone, for those of you that are looking for ideas for debit versus credit spreads, Options Play offers two services to help you find ideas and opportunities for debit versus credit spreads. So for those of you that are already Options Play subscribers, you probably get our daily play emails. Those are the emails that you get every morning at around 6 a.m. Eastern time. This is free with your Options Play subscription. What we do is we provide daily directional ideas with a debit spread on those trades. And you can access them either through the email that we send out every morning, or you can access it through the Options Play platform when you log in. It's the first pop-up that you see every morning. And this email goes out every single day at 6 a.m. Eastern time. So you get that every single day with the trade idea, and it's always a debit spread. And for those of you that want to learn more, you can go to optionsplay.com/daily play. For those of you that sell credit spreads and you're looking for opportunities on the credit spread side, we do offer a separate service just for credit spreads. It's a $39 a month subscription service through StockTwits. We deliver these credit spread signals through the StockTwits platform. We send frequent credit spread signals through this service, and you have email and phone notification for these services. And the difference between the debit versus credit spreads is that the credit spreads are sent during trading hours. So we send them out usually between 2 to 4 p.m. Eastern time. As long as you have access to your email or access to your phone, you will get those notifications. And if you want to learn more about those, we will include a link in those slides at stocktwits.com/r/optionsplay-signals. So for those of you that are interested in learning or seeing some credit spread or debit spread signals, make sure you check out one of these two in order to learn more. So let's go ahead and take a look at some of the questions here. Please, again, if you have questions, type them into the chat window, and I'll answer as many questions as I have time for. So the first question here is, are the ratios, risk-reward ratios or reward-to-risk ratios? The 2-to-1 and 3-to-1 are reward-to-risk ratios. Please verify. So it's used interchangeably, and it really doesn't matter whether you use risk-reward or reward-to-risk as long as you have the numbers correct. Risk is referring to the max risk of the strategy, and reward is referring to the max reward of the strategy. In my opinion, it doesn't really matter how you quote them as long as you have the two correct. Don's asking, how do you use the score? And I think you're referring to the Options Play score. The Options Play score is effectively telling you this type of information in a summary basis so that you can actually compare them side by side. So as you can see, one's risking $1,900 to make $1,000. One's making $2,100 to make $3,800. But this has a probability of profit of 65%, and this has a probability of profit of 41%. So these are all numbers that you have to crunch in order to really understand the true risk reward of each strategy. So that's why we created the Options Play score, to calculate the true risk reward of each strategy so that you can actually compare them side by side. So that's really why we use the Options Play score, and it's color coded for you so that it's easy to remember. Red means that you have poor risk reward on the strategy, green means good risk reward, and yellow means average. Um, Alfred's asking, can I replay the webinar? Yes, the webinar is going to be available for replay. We'll be sending it out about 30 minutes after we finish here, and I'll also send the slides out to you so that you'll have both the recording as well as the slides with all the links about 30 minutes in your inbox after we finish here today. Why are not a single service for both? So like I said, the debit spread is free of charge with your options play account. The credit spreads is a completely different service. It's offered at a premium service. Like I said, we deliver that through StockTwits, and that's an additional $39 a month. Debbie's, can you please explain the credit spread when you hit the trade button? So when you hit the trade button, what you have here is you have two legs. So here on the Rockwell automation, what we're doing is we're selling that at the money call, that 180 call. And what we're doing is to offset that risk, what we're doing is we're buying a 190 call, a higher call against that to offset our risk so that we have a max risk of $1,900 versus max risk of unlimited. Because if you just sold the 180 calls, you would have unlimited risk. If Rockwell automation took off and started shooting higher, you would have unlimited risk to the upside. And that's really why we sell credit spreads, is to take advantage of selling that 180 call, but not have to take unlimited risk in order to trade that strategy. KC, thanks for answering that question. Irina, you're very welcome. Serge is asking, Dollar General, please model for a bullish credit spread. So we'll take a quick look here. Dollar General trading at 118. I would say that this certainly has broken above a 117.5 resistance level, coming back to retest that. I think what you're saying is you think that this is at least going to hold that 117.5 level, and you would expect to at least move sideways, possibly a little higher. So if you want to sell a put credit spread here, I would look at maybe the March 15th, the monthlies. Roughly, like I said, we want to collect about a third of the distance. So 113, 118 is $5. This is collecting 165. So yeah, roughly exactly 1/3 of the distance between 113 and 118. And so this is what I would be looking at if I was selling Dollar General. I'd sell the at the money puts, the 118 puts, and I'd buy roughly about a 113 put against that. When I sign up for the premium service is $39 a month. So we send out trade alerts as many as we get. We probably average about 15 trades a month on that. And we average about the same amount of trades for both credit and debit spreads. About 15 trades a month is probably average. What time of day do you prefer to buy spreads to avoid big spread? So the only time that I would say that you want to avoid trading is about the first 5 or 10 minutes of the trading session and the last 5 or 10 minutes of the trading session. That's when spreads get widened out. Anytime after the first 10 minutes or so and the last 10 minutes or so, in my opinion, is ideal times to enter a spread, enter any trades rather. If you only subscribe to StockTwits, then you do not have access to the full platform. So StockTwits, again, is a separate service. It is just the signal service for selling credit spreads. For the debit spreads, you're going to get access to everything, including the whole platform. So just to be clear, the debit spreads is just a service that comes with the platform. It's not like we're selling signal services for debit spreads. I realize that you can change the go-to price in the trade panel, but how's the initial price determined? And the question is, how's the initial price of this P&L slider determined? And that initial price is always going to be the one standard deviation move for that stock for that expiration date. For credit spreads, we need to hold until last minute to get the benefit with the time decay. but how to guess or predict the price close. So there's lots of ways to try to predict the price movements. Traditionally, most users will use technical analysis or the charts to do so, but there's lots of different ways. You can use fundamental analysis, you can use statistical analysis. There's no shortage of ways of how to predict the markets, though it all comes down to how good your method is, but a predominant use case is using the charts for figuring out what direction the market is headed. What is the membership for Options Play? Options Play is $50 a month or $500 a year. The question about the Amazon bulk put spread where you sold it at a loss and would have made profit back today. If you don't mind, I'm happy to answer questions like that, but I don't want to take time to answer personal questions of a specific trade. So if you have a specific question regarding that, please send me an email at info@optionsplay.com, and I'm happy to answer those questions for you. Does Options Play send out credit spread trades to subscribers? So we only do that if you sign up for our credit spread trading service, which again is available to you at stocktwits.com/r/optionsplaysignals. So I will include a link for this to you guys in the slides that we send out after the webinar. Is Options Play integration with Fidelity? So we have a partnership with Fidelity. So if you have a Fidelity account, you do get a discounted version of Options Play. How to enter orders. So you enter your order actually at your brokerage firm. So whatever order that you're looking to place, you hit the trade button and we will tell you how to enter this trade into your broker's platform. So you would still have to enter that into your broker's platform. How many trade alerts do you get with the StockTwits? So again, we average about 15 a month on that service. Raymond, thank you so much. I really appreciate it. Are there any other questions? If there are no other questions, I just want to thank everyone for taking the time out this afternoon here. I really hope that you guys found this webinar useful and answering a lot of the questions that many of you have asked me actually over the last few weeks about trading debit versus credit spreads. I actually had quite a few questions last night, and I see many of you actually on the webinar after I told you to come to it. Debbie, thank you so much for coming. This is really designed to help you guys learn more about these strategies and make sure that you understand how to deploy your capital as efficiently as possible. That's really why we do these webinars. And I'll be back here next week, next Thursday, on another webinar, and I hope to see you guys back here. So thank you so much for taking the time out this afternoon. I hope you guys have a great evening, and I'll send out the recording to everyone in about half an hour. Thank you, Greg. Thank you, Calvin, Grant, everyone. Thank you so much. I hope you guys have a great evening.